Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is September 23rd of 2024, and we are a week removed from the FOMC rate decision. Now, it was a big rate decision. It was a historic rate decision, not because they cut 50 basis points, but because of what it signaled. After 2 to 3 years of restrictive Federal Reserve policy, where we saw historic rate increases from 0% all the way to 5.5%, we are now in an environment where the Federal Reserve can recalibrate its policy. That was the exact word that Jay Powell used. We can recalibrate that policy away from attacking inflation through lower economic growth and move back toward supporting employment and economic growth because inflation has come down. That has significant consequences to how we look at the economy, the business cycle, and of course, overall asset allocation as it relates to your portfolio. So we're going to go through all of that this week because it's one of the more important weekly updates that we've had over the last year or two because of what the Federal Reserve is doing and how it impacts how investment dollars are allocated across the board. So the title of this week's presentation is that Powell slashes rates. Now, the 50 basis points, that's happened before, right? But it's really this sharp shift in tone away from restrictive policy towards supporting and cheerleading economic growth and employment growth. Very, very key. So the three big things that we're going to focus on this week are some of the technical price action of the S&P 500 post the FOMC rate cut, looking at breadth conditions, looking at that advanced decline line. What does it all mean for today and tomorrow and over the next 3 to 6 months? Number two, those post FOMC takeaways, right? So the Fed made that decision to cut rates 50 basis points. They made the decision to recalibrate from being restrictive to accommodative. What does that mean for you? Lastly, asset allocation in a world of falling interest rates, right? There was a way to manage the portfolio as interest rates went up. We made some mistakes along the way, but we also know the playbook to put into place for when rates are starting to fall. We're really confident in terms of how to deploy that, and we're going to look at some of the areas that we think are going to benefit from this recalibration of FOMC rate policy. So when we look at the S&P 500 right now, things remain pretty good. The symptoms look good, right? So when we think of a rate cut, not all rate cuts are created equal, ladies and gentlemen, because sometimes the Fed can be cutting rates in response to an emergency, right? So in September of 2008, they cut rates, but it was not a good time to buy stocks. And the internals showed that, right? Breadth was shrinking quite rapidly. Fewer and fewer stocks were rallying. In fact, almost no stocks were rallying. And almost every stock was flipping into negative trend. That is not the case this time around. What you see are very strong internals. More and more stocks are participating in the rally. The right areas of the market are leading the charge. That's exactly what you wanted to see. Not only are we challenging prior highs now, we've made new highs on the S&P 500. And the good news is it's not just the Magnificent Seven names anymore. We're seeing very good breadth. It's being led by mid-cap and small cap growth. Small cap has been very strong over the last 2 or 3 months. These are the types of conditions you want to see to be able to say, hey, you know what? The market is not trying to warn me that a recession is on the way. Now, one of the things that we do look at is momentum. Momentum is a thing, and it's real. And when we think of total year performance and what we can expect in the second half, and in particular, how we navigate September and early October, because that is seasonally and historically the worst time of the year for the market. For whatever reason, that all the problems tend to percolate around September and early October. So how do we address that? How do we navigate through that? What determines whether we are patient and sit through the storm or take action, raise cash, and play defense? A lot of it comes back down to not just where we're at in the business cycle and the economic data readings and earnings and those more traditional fundamental metrics, which we do look at, of course, but looking at the momentum of the market. So when we look at years where the first half of the year, the stock market or the S&P 500 returned 10% or greater, the historical second half performance was around 9.8%. Now, if you do start to see cracks underneath the surface, what we see is that the market tends to ignore those cracks until you get into January, February of the following year. Why is that? Again, there are many reasons, but a lot of it is, hey, you know what? Portfolio managers, pension funds recognize they're having a good year. The data is good. Earnings are good. Let these stocks ride into the final month of the year. And then we will reassess the economy and businesses and what that means for earnings in January. Again, those cracks sometimes are false signals. So people don't want to take action on those false signals. But that's part of why that happens. The other thing that I will say is that when you have the first half of the year have 10% or greater performance, the win ratio in the second half is around 83%. So in other words, 83% of the time, when the S&P 500 returns 10% or greater in the first half, you tend to have positive performance in the second half of the year, and that average return is around 9.8%. Now, does that mean you can't lose money? Of course not. 17% of the time, markets go down, right? So, but the key message here is that if you're a Vegas person and you're playing the odds, these are pretty good odds. Can you have corrections along the way? Absolutely, right? The average amount of corrections in a bull market year is around 2. You can have 10% plus drawdowns in the stock market in a bull market year. That's what history suggests. And guess what? They're painful and they're scary. And you get the trucks that are outside the NYSE from CNBC with the big red headlines of the world is ending. And you got Jim Cramer squawking about the end of times. And guess what? Markets proceed back to highs, right? Remember, it's time in the market, not timing the market. Now, is this the only data point you should look at? No, of course not. It's part of a mosaic of data that we consider and weigh on any given day, week, or year. But it's an important thing to look at from a momentum standpoint. If the first half of the year was strong, that tends to, from an economy standpoint, economy also has momentum. So strength begets strength. Consumers spend money. Guess what? Those stores have to order more merchandise from the supply chains. Those supply chains have to source the innards of those goods from their own suppliers. So it becomes that positive momentum, that flywheel continues to increase in momentum until it loses momentum, right? And so, no, it's not the only data point you should look at, but it's something that we consider as part of that broad mosaic. And when combined with other data, can it help you tactically adjust the portfolio? Absolutely. So if we're coming into September, breadth is weak. Momentum in the first half of the year was weak. It just seems to be one of those years where every step you take, you're stepping on another rake. Yeah, that might be a sign that you want to view September and October with trepidation and play defense and raise cash. But when you're going into September, October with a head of strength, you may just want to be patient and let markets do its thing until they come right back up. And that's really what we've seen so far in September. So what are some of the post-FOMC takeaways? We believe a soft landing is now intact, right? We think the message by the Federal Reserve through that 50 basis point rate cut is they are here to protect the economy against a recession. Does that mean they can't make a mistake? Of course not, right? The economy is bigger than the Fed. It's bigger than the president. It's bigger than Congress, right? The economy will do what the economy does, but the Fed will not get in the way, right? So we believe we are not barreling toward a recession, and that is a key input to how we look at asset allocation. Another thing that we love, high yield bond prices continue to rally. We go back to 08 or even COVID or 2000, 1987, 1982. The bond market sniffed out a recession ahead of time. And you started to see those high yield bond prices fall, those credit spreads or those risk spreads start to rise or widen out. You have not seen that this time of the year. Another reason why we were tactically patient in the month of September. S&P entered September's weakness from a position of strength. Advanced decline lines hit all-time highs in August prior to the pullback. This is not the type of move you want to short when markets start to have those spasms. And lastly, of course, we talked about this last slide, that strong first half performance usually does indicate a strong finish into the end of the year and into the month of January. The other big thing we've noticed is the rest of the market are showing signs of catching up. The S&P 500 equal weight hit an all-time high. As you can see here, the semiconductor index still breaking out after the deep correction that those stocks faced through the month of summer, and they have not reached new highs, right? Now, does that mean it's bearish for the stocks or the semiconductors? No, of course not. All this is really telling us is that you're starting to see more stocks participate in the rally, right? So our job is to say, how do we position for tomorrow, not for yesterday and what worked yesterday? There are certain semiconductors we like and certain semiconductors that we think, guess what, are probably overheated and still need to come down some more. But that doesn't mean that we can't play technology. That doesn't mean we can't play semis. We're just going to be selective of, hey, what didn't participate in a big way in the first half of the year in 2023, that as rates come down, that risk appetite will go up for investors or could go up for investors and allow these stocks to play a little bit of catch up. And, it really is critical that the Fed sticks to landing. So wanted to show this slide really quick. So when the Fed cuts, but it's accompanied by a recession, the forward returns are negative and the win ratio is around 20% 3 months forward, right? So on average, when the Fed starts to cut rates and it's into a recession, the average S&P 500 return is minus 7.5%, and the percentage of observations that the market is positive versus negative are only 20%. Terrible odds. When the Fed cuts and there is no recession, the forward returns 3 months out is 8.4%, historically, average. And the 6-month average forward return is 12.8%. But look at this win ratio. It's 100%. So 100% of the time when the Fed cut rates and there was no recessions, markets went up 100% of the time, 3 months and 6 months forward. Now, could this be the first time that it doesn't happen? Could be, right? But if we're right about the fact that the market is not, or that the economy is not going into a recession, we like those odds and we'll play those odds versus other odds. And what we will also say is this action from the banks and from high yield bonds is suggestive. We look at the market from a symptom point of view that things are pretty good. The financial sector almost at all-time highs. Percentage of bank stocks or financial stocks that are in an uptrend around 86%. And one area underneath the financials that has acted particularly well has been fintech. You look at some of these buy now, pay later stocks. The results have been good and the stocks are acting great. Buy now, pay later would be one of the first areas that got hit, would get hit, in our opinion, if we went into a recession, because your average credit score with a buy now, pay later consumer is significantly lower than some of the prime consumers you see at the big banks. So again, the symptoms are suggestive of a soft landing. And the bond market's already been front running that. The 2-year yield, which tends to track Fed policy, is around 3.6%. That tells us that at some point here, this Fed funds rate is going to catch up to 3.6% or beyond, right? This should generally match, and the market is front running that right now. Credit markets are seeing the exact same thing. So what are the riskiest index of bonds? Those are the CCC bonds, right? These CCCs are junk bonds. They're bonds that are actually close to default. That's why they're rated CCC. Look at the credit spreads on the triple Cs. Look at the huge amount of de-risking that's taking place. Remember, when these spreads go down, prices for these stocks go up. That's huge. The fact that these credit spreads are doing that is suggestive to us that we're not just going to see rates coming down, but the Fed is indeed sticking the landing. Because if we were going into a recession, it's more than likely that these spreads would be blowing out because they have the weakest balance sheets and are the ones that benefit the most from lower rates, but get hurt the most when rates go up or when recession hits. And we also think gold is trying to tell us something. Gold and silver. So you got gold hitting all-time highs. Silver, which is sort of considered your poor man's gold, is also breaking out and challenging all-time highs. What is the message here? We don't believe the message is one of end of world. If you look at the prior slides, I think you can see why we're saying that. The message is here that rates are indeed likely to continue falling, which is going to be bearish for the US dollar. And that's why it's important to look at gold as a currency, right? It's not a protection tool, it's a currency. In 2008, gold fell 28%. Did not offer a lot of protection. It's a currency hedge, right? What went up in 2008? The US dollar. What's going down right now? The US dollar. So if rates continue to fall, especially relative to other countries, right? Those interest rate differentials continue to widen out against the US dollar. We should see the US dollar continuing to fall. We could rally short term, but longer term continue to fall. And that tends to be positive for gold. Gold historically acts as a hedge against the value of the reserve currency at the time, whether that was the British pound 100 years ago or the US dollar today. So we think the bottom line message here is that the market is telling us that the Fed pivot is real. So if the Fed pivot is real, what does all of this mean? Well, we believe we should sell the top of the market, right? So like the Magnificent Seven names, if you're over allocated into that, like most portfolio managers are these days, we believe it's time to reallocate to other areas of the market that have not participated in those narrow gains of the last year or so. Small caps, financials, mid cap, small cap growth names, digital assets such as Bitcoin. These are areas that we think can benefit quite a bit in a lower rate environment that is not accompanied by a recession. And lastly, long duration versus short duration across the bond market. That all means taking bonds that have a longer life versus a shorter life. So bottom line here, ladies and gentlemen, the FOMC move to cut interest rates is a big deal, and we shouldn't let the media noise distract us around that. Focus on the recalibration of policy away from attacking growth to supporting economic growth and employment. Market internals are suggestive of a soft landing. And lastly, those small and mid-cap growth stocks that have been left out of the rally so far, we believe because of where the Fed is going and recalibrating that policy, they will begin to play catch up relative to their mega cap peers. So that's what we got for you this week, 888-543-3776. Please reach out to your advisor, reach out to us if you have any questions whatsoever, and have an absolutely fantastic week. And thank you again.